Today we have with us Josh Liaw, who is CEO of Elite UK REIT's manager, and he's going to discuss with us how he's brought the REIT back to health.
Right? Thank you. Thanks, Bella. It's a pleasure to be here.
Apart from yourself, what else would set Elite UK REIT apart from other REITs?
I think we're fairly unique. Other than being listed in pounds currently, all assets are in UK. So none of the other REITs have a UK 100% exposure. Some other REITs might have, a few percentage exposure to UK, but we're 100% UK. Other than the GBP listing, the UK focus, a lot of our properties actually lease to the UK government, or any government in that sense. If you look at the other REITs, some of them might have government tenants here and there, but when you're looking at 99% exposure to the UK government or to any government, the sovereign, we're the only one out there. So that's fairly unique as well.
But then your unit price went up, one of the best performers last year. Yeah. Why do you think that happened?
Well, I think it's a combination, a cocktail of factors. One was interest rates. I'm not going to claim credit for that.
But when you came in, interest rates were the highest they'd ever been.
Exactly. So that was good luck, I guess, in some ways. But also, I think what we could do as a management team is to stay nimble and to react and to be prepared for what the future was to come.
So, what would you say are your key achievements in the past year?
Well, maybe I'll extend that to 3 years. I think when I first joined in 2023, this REIT was having quite hard times. The first thing I think we did was to listen to a lot of equity analysts and to meet up with investors to hear what they want. A lot of them were actually very worried about the gearing with our credit matrix. So what we did was, the first thing we did was to do a equity fundraising to bring down our gearing. And on the back of that, we then refinance the banks. And that has helped us get a good start. Not only with lower interest rates, but also terms that are more favorable to Elite UK REIT. And then I think the other thing that we did in April 2024 was to expand the investment strategy. So, when we do get some vacant properties returned back to us by the tenant back in 2023, we could do basically two things. We could either relet them or sell them, right? But having a strategy to be able to convert some of these assets into student or residential units, the living sector as we call them, really gives us another tool in our toolbox to deal with this sort of situation. And I think we have also used that now not just as a risk mitigant, but also a way to grow the REIT organically as well. So I think that's what we have done. Last year, we had a small EFR and a small acquisition mid-year in June, and it was probably one of the smallest deals I've ever done in my career, but very well worth doing it because once we did that, our liquidity actually jumped, and we managed to bring in quite a number of institutional investors into our register as well. Then these are all long-only equity investors as well.
You had your lease extensions, 70% of the portfolio. What's going to happen to the remaining 30%?
We always knew that was going to be a question, and it's a very fair question. But if we have done 30%, people will be asking about the remaining 70%. If we have done 90%, it's a glass half full, half empty, type of view, right? But we're working on the remaining 30%. I think we've consistently guided the market that we think that a large proportion of the entire portfolio will be renewed, and that's true looking at the historical behavior. And also now looking at the state of politics and social welfare in the UK, we still retain that sort of belief. So now 70% is done in our pocket. We just need to deal with the remaining 30%. Some of it will get renewed and some of it won't. For those that doesn't get renewed, it's important to have a plan B. And that could be also a great opportunity for conversion into some of these other things that we want to look at, like the living sector.
How does Elite UK REIT create value with its properties?
We've got a very interesting model. We've got the government-based rental coming in regularly, so that forms our financial moat, our dividend core, right? But apart from that, it is somewhat also a little bit of a long-term land bank with a cash flow. So this land bank, when it's ready, when we are ready, we can take them and reconvert them into other uses, as we've done in the last couple of years.
Would you like to give a couple of examples?
Yeah, so for example, last year we put in an application for a change of use for one of our previously office building. This is in Dundee, and we have then gotten planning approval sometime in July last year to convert it into a student accommodation. That's well underway. We're targeting to open for business in September next year, so that's quite soon. We have also taken another property forward in Cardiff for student accommodation. We have gotten positive pre-planning, and I think very recently as well, we have also announced to the market that we've received planning approval to change one of our properties into a data center land.
Have you thought about diversification and tenant risk? Yeah. Because you've got one big tenant and maybe a few smaller ones?
Yeah, also altogether we have about 10 tenants. One big one, as you say, which is the Department for Work and Pensions. Yes, I think that's in our minds, but I think far more important than having different tenants is having different lease maturities. Because if you recall, right before 5th of February, where we announced the regearing, a lot of our leases all end on 31st March 2028.
2028.
Yeah, which I think is quite a fair bit of concern, right? Rightfully. So we've actually extended that into various lease maturity, not another big chunk of 10 years again. It's some in the 1, 3, 7, and 10, mostly in the 7 and 10. Okay. So that's helpful. And last year, when we did a acquisition of 3 government assets, we bought actually non-DWP properties as well. I mean, we're making small improvements in that diversification. To answer your question, whether there's any risk, it is actually a sovereign risk. You could sign your leases at different levels. We've signed our leases at the Secretary of State level. So that's like a crown body. So it's your view on what that risk is. Ultimately, the UK is rated AA, right? So that's as good as other big OECD economies.
Have you thought about having the REIT either trading in a different currency or paying out your distributions in a different currency, and how this would impact your hedging policy?
I think legacy-wise, we listed in 2020 with a GBP listing, right? And that has served us rather well. But always we like to think about fresh ideas, and that's something that we would seriously consider. Currently, actually, our unit holders can elect to receive the dividends in 3 ways. Number 1, GBP. Number 2, Sing dollars. And number 3, scrip dividend. So it's quite fairly flexible.
You're quite flexible there.
One of the drawbacks of not being listed in Singapore dollars is that you don't have direct access to the CPF funds.
Right.
And I think we have also looked at some of our peers, some of the other REITs listed on the SGX. They have a exposure to a different market in different currency, but they have a Sing dollar listing, and that seems to have helped them with their liquidity. So we're definitely keen to look into that.
Okay, thank you very much. This has been very interesting.
Thanks, Gula. It's always a pleasure.